Hey guys, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and best-selling international author of Australian Real Estate Investing Made Simple. Welcome to today's video. I've just got back from Port Douglas. I stayed at the Sea Temple resort there. It was amazing. I love the swim-up bar. Couldn't get enough of the swim-up bar. Now after 11 days, back to Melbourne, back to reality. So here we are. Bit of a personal disclaimer that nothing that I'm teaching you today is specific advice. I have never met you. I don't know your set of circumstances. This is purely for educational purposes. And by all means, seek professional advice before you act on anything. Bit about my background before we get into the property market. My formal education is that I wasted 4 years at Monash University doing a business course. Then nearly did an MBA, more about advice. But I thought I'd get out of there and start making some money. So I got into real estate. I'm a real estate agent, mortgage broker, and I've also got a diploma in financial planning. The most important thing is that I'm actually a property investor myself. In Melbourne, I've got a multi-million-dollar property portfolio, and I'm dealing with developers, valuers, lawyers, other investors all day long. So I've got my finger on the pulse, and all I do is source properties for private clients. The last 3 years, my clients have made an absolute killing on properties despite all the doom and gloom in the media, and I'll show you which suburbs I predicted will boom during the COVID-19 lockdown, and I'll show you the actual results. Now, I can't make this stuff up. It's actually time-stamped on YouTube, so I'll show you the exact YouTube video that I did in September 2019, and I'll show you the results that these suburbs got because a lot of them went up by 20 or 30%. Most of the academics were dead wrong over the last 2 or 3 years, as they're always wrong. You know, they're just because they're broke. They've got no results. It's just all theory. Do you know how many people, when I was predicting that Melbourne's going to grow at 20% during COVID-19, they were laughing at me. They were saying it's impossible. There's going to be a tsunami of insolvencies. The JobKeeper, job seeker will end. People will be out of work. The economy will be in lockdown. Konrad, how is it possible that these areas are going to go up by 20 or 30%? And guess what happened? They exactly did just that. I was right, they were wrong. And I've won a lot of bets, by the way, on LinkedIn with a lot of so-called experts predicting doom and gloom, and they were completely wrong. Now, yes, we are definitely going into the lowest part of the property cycle. The market is cyclical, I've always said that. Goes up and down, and I'm going to unpack that in detail today. So today's video is purely about the property cycles, where we are in the property market, what's going to happen in the future, which areas are being affected, which areas are being smashed in Melbourne, which areas are booming in Melbourne, and which areas to focus on, and which areas not to focus on and avoid, like a teen arena concert. Also, if you want to get a copy of my real estate book, just jump onto realestateMadeSimple.com.au. You can get a copy there. If you buy from those websites, you get a free home study as well as a bonus, which is fantastic. By the way, I want to thank you everyone for supporting my book. As I mentioned on every video, my book has gone #1 multiple times on Amazon. You can see that it's #1 in the real estate investment section. At the same time, my finance book is #8. A lot of times my books have been #1 and 2, #1 and 3. So I really want to thank you guys for buying my book, because it's one of those things when you write books, you don't know if anyone's going to read it, apart from your mum, of course. And I'm really glad that you guys were buying them. I'm selling hundreds and hundreds every month, so it's fantastic. Now, let's talk about the Australian property market in December 22. There's been a lot of doom and gloom in the media, obviously. The war in Ukraine, you know, energy prices, food prices escalating. 7 interest rate increases by the RBA. People are in pain. In fact, if you look at the Consumer Sentiment Index from RP Data CoreLogic, it's the lowest that it's been since the GFC 2008. So people are very concerned out there, generally speaking, and very negative about the future. There's a lot of uncertainty. So it's very interesting what's happening at the moment in terms of the economy. I tend to step back and look at the whole big picture when I look at real estate investing. And you've got to hold the big picture in mind. If you get bogged down in the minutiae, you're going to miss the big plan and you're not going to invest. You're going to talk yourself out of it, which a lot of people do really well. And that's going to keep you poor. So what I want to do today is not just look at a bunch of charts and figures, which I'll definitely cover, and I want to give you a lot of stats about what's happening right now. I want to share with you the psychology of a lot of investors and developers that are very wealthy, that have done really well. They've been investing for 20 or 30 years in Melbourne, and what they think about the market. Because then you can relate to other people that are successful. I mean, the simplest way to become successful, guys, is just to find a bunch of people that are very successful in the chosen field. It doesn't need to be property, it could be sports, it could be anything, trading the stock market, and just copy what they do, and also gain an appreciation of how they feel about things. What's the psychology, what's their mindset at the moment? The worst thing you can do is talk to broke people. You know, and this is what people do. They go and talk to their neighbour. Well, if your neighbour is such an expert, what is he doing living next to you? Think about it. You got to talk to people that are successful. So in overall, the Australian property market is now worth $9.4 trillion. It used to be $10.1 trillion, but apparently we valued every property in Australia in the last few months. And RP Data has come back with a $9.4 trillion valuation. 2.1 trillion is in outstanding mortgage debt. So the first thing you got to understand, the gearing ratio in the property market is 22% LVR. Now think about the whole economy as being a household. If you had a mortgage of 22%, so let's say you got $1 million house and you got a $220,000 mortgage, would you be stressed as an individual? Is that a huge amount of debt that you're holding? No, it's a very low amount of debt. 80% LVR is very high. 22% is virtually nothing. So the first thing you got to appreciate about the market, despite all the doom and gloom and the predictions of the property market crashing, Armageddon, blood on the streets, is that the gearing ratio is extremely low. It's 22%. And the most important thing to understand is that 22% is concentrated in the fringe suburbs, in new house and land estates. The best suburbs in Melbourne, Sydney and Brisbane are completely paid off. They have very low mortgages, maybe 5%, even less. And most of them are lines of credit or regional facilities used to trade shares or hold equity just in case they need it. So the first thing to understand is the mortgage debt is very low and it's focused on new estates. There's no debt in Australia. So this notion of the property market crashing is absurd. And yes, it is cyclical, by the way. The market does go up and down. We'll talk about that today. I'm going to unpack it in detail. And I'm going to give you all the resources as well, so you can check this information for yourself. Don't just take my word for it. You know, all this information that I'm going through today is from RP Data CoreLogic and Herring Todd White Valuers. They're completely, these are the biggest companies in Australia in their field, you know. It's just how we interpret the data that makes a difference. Not about the data itself. So overview, if you look at, 3 months, this is Australian dwelling values, which is, I don't know what the point is of that, because it's taking Sydney properties for $50 million and putting them together with properties in regional towns and Adelaide for $450,000. But anyway, if you group all the properties together, in the last 3 months, November, the market went negative 3.5%. 12 months, 3.2%, which is statistically correct. So the market is down, absolutely. If you look at the cyclical nature of the market, it is definitely down in November, and it had a slight pickup. Now, whether it's a true pickup or not, we won't know until January, probably February, when we look back on the data of December and all the sales coming in. Because remember, the best data is around 3 months old. Because when agents sell properties, a lot of the sales don't get reported in time and they don't get captured accurately. So really the most accurate data we have as real estate agents is around 3 months old. And we're always looking back at data. We're always looking back at the market saying, oh, that's where we were 3 months ago. So really what we had a property boom, and this is changing dwelling values, and now we're going down and we've just had a slight pick up. So yeah, Australia 3.5% negative for all the combined major capital cities. For combined regional centres, negative 3.6. And for capital cities by themselves, 3.5. 12 months average, same story. We had a boom of 20% on average, now negative. So if you look at combined capital cities, which is the dark purple line, negative 5.2. And if you look at combined the rest of the state, 3.3 positive, yet to go down. There's always a delay between the major capital cities and regional centres. So the major capital cities take off first, and then 6 months later, 12 months later, depending on which regional town we're talking about. For example, in Melbourne, we've got the biggest regional towns are Bendigo, Ballarat, Shepparton, Warrnambool, for example, and Geelong. Those towns kind of follow the market of Melbourne. Okay, so it's always kind of a lag delay, and it's sometimes counter-cyclical as well. It's not always a mirror reflection of what's happening in Melbourne, but to a large extent it has a strong correlation for the last few years. But there's been a number of years where it hasn't correlated very strongly at all, where regional towns have been very consistent, low growth, and Melbourne's was shooting up far beyond what regional towns were doing. So definitely, if you look at 12 months, November 22 to November 21, yeah, Australia has negative 3.2% growth. Combined regionals, 3.3%, because they boomed because of the tree change, sea change. And combined capitals, negative 5.2. If you look at the individual cities, definitely, you can see there's a strong correlation between the cities. So Sydney, Melbourne, Brisbane, Adelaide, they all kind of follow each other pretty closely, and you can see there we've hit the bottom of the market and then we're bouncing off the bottom. The peak was around here, and now we've gone up slightly. And then if you look at the other part of the market, which is Perth, Hobart, Darwin, ACT, they're kind of a little bit all over the place. Now they've kind of consolidated, but they're also coming down, and now they're kind of bouncing back up. My gut feeling, guys, is that the bottom of the market occurred in October, November this year. But I'm not 100% sure. We could have a W pattern because of what will happen next year. If the RBA does another rate cut, increase, I'm so used to saying cut, but it's actually, last 7 have been increases, then the market will be negative again. It's just one of those realities of what's happening. Now remember, with each major capital city, you have different price points of properties. I mean, people say, what's Melbourne doing? Well, Melbourne is St Albans and Toorak. There's no such thing as the Melbourne property market. There's 400 suburbs plus that represent Melbourne. What's Melbourne? Which part of Melbourne? There's 8 distinctive markets in Melbourne doing very specific things. As an investor, you've got to be very discerning, because if you generalise about the market, you're going to get average results. You've got to specialise and you've got to go deep into the stats. So in Melbourne, the best way to break up the market is into percentiles based on price point. So you have the cheapest properties, which is your 25th percentile. Then you got the 50th percentile, which is your mid-range property prices. And then you got your 75% plus properties. So imagine the most expensive properties, cheapest, and the mid-section. That's a really good way of breaking up the market. Pardon me, I've got a bit of a cough that I picked up on the airport from coming back from Port Douglas. So in Melbourne, for example, the cheapest part of the market, which is the 25th percentile and to zero, which is the cheapest part of the properties, that's gone negative 2.6. The main market, and I guess when we talk about the market, we're kind of talking about the general market at large. We're talking about negative 3%, and the high end 2.1% negative, which is really low. And this is for 3 months to November. And if you look at the same thing over 12 months, you'll find a very similar story. And the reason being is because the top end, even the top end, specific suburbs can go negative. What happens in the top end is people take the properties off the market. So the amount of volume of listings in some suburbs like Toorak and Hawthorn and Brighton is 30 to 40% lower right now than it was 12 months ago. So if rich people with unencumbered properties can't get the price that they want, they simply will take the property off the market. There's virtually no pressure for them to sell at the wrong time. This is the opposite of people living in Point Cook or Roxborough Park or Pakenham. When they need to sell because they're probably going under. And the mortgage stress levels are very high in those suburbs. So, for example, let's say you're in Toorak in a $6 million house, which is an average median price now, and you can't get $6 million for your property. There are people offering you $5 million. You've got no mortgage against the property. What do? You ring up the agent or allow the 90-day exclusive authority to expire, and you simply go, well, hun, let's just not sell the property. We just have to suffer in silence in our 2,000 square metre Toorak mansion for the next few years before the market recovers. In Point Cook, where the mortgage is 95%, usually when they're selling, they have to sell. They've got no choice. So it's a very different consideration about different sectors of the market and in terms of what's happening. Housing cycles is what I want to really unpack today and talk about the property cycles, because this is a huge trap for novice investors. So if you've got less than 10 properties and even less than 5, and you're trying to time the market, you're crazy and you're going to lose money and time. Remember that the biggest asset you have in your life is time. Time is always running out. Timing the market is not a good way to make money, in my experience. Timing the market will lead you to sit on your ass, do nothing, wait for this magic, mythical moment to get into the market where you think you're going to get a bargain. And when the moment comes, two things can happen. Your serviceability might be so low you can't get into the market. Number two, maybe there's no bargains. Maybe the properties that are selling are not the right properties to focus on. And this is what I see time and time again with engineering people who virtually never invest. They talk themselves out of it. And it's just because the level of awareness isn't very high in terms of what they need to do. So it's easy to justify, oh, interest rates are going to go up, I don't want to be stressed. Well, do nothing and just keep paying your 70 grand a year in tax. You're contributing to the economy. It's just craziness. But, we can't, it is what it is. So, for example, in Sydney, if you look at the property cycle, in November, Sydney lost 1.3%, for the quarter 4.4%, and for the last 12 months 10.6%. Does that mean that every house in Sydney devalued by 10.6%? Potentially, probably not. Probably some houses are 20% lower and some houses have gone up by 10%. So this is the average. This is the median price, the middle property sold in one market versus the middle property sold 12 months ago. That's all it is. It's the relationship between two middle properties. It's not every property correlated against every other property. Okay? So the median price movement analysis is extremely flawed in what it's trying to convey to the investor. It is probably the most useless statistic that I use. When I started investing, and I've been investing now since I was 18, I'm 46, right? So we're going on to nearly 30 years of investing. I've seen a lot of property cycles. When I started investing, all I was focused on is median price movements. My whole analysis was based on median price. Now I don't even look at the median price. I look at the median price per suburb, but not per markets, because it's just too general for me to derive any substantial meaning from, So definitely, like in Melbourne, yes, November 0.8%. I love when the media says it's the highest drop since 1956. So, what does that mean? Yes, it's the highest drop. People are still living in $20 million houses. People are still living in $1 million houses. People are still living in $700,000 houses. Doesn't mean anything. It's just they say this stuff, and the uneducated public goes, "Oh my God, maybe it will crash. Maybe I shouldn't get in. Maybe I should just keep working, paying tax, and never investing." Maybe, I don't know. Quarterly, 2.7%. For the last year, 7% decline in the median price movement. Remember, it's just the middle property. That's all it is. What does a 7% drop mean? Does it mean anything? No, it doesn't mean anything. Are consumers negative out there? Yes, definitely. Are people stressed around money and mortgages? Definitely. Are people stressed around money and mortgages in the suburbs that I'm investing in? No. They're not, because they're the highest income earners in Melbourne, and that's what you should be targeting. You don't invest in Frankston, you don't invest in Point Cook, you don't invest in South Morang. You invest in the most expensive suburbs with the highest disposable incomes that you can get into, because ultimately this is how you make money. You buy Rolexes, not Seikos, guys. If you think Seikos are going to go up in value, you're kidding yourself. Cheap today, cheap tomorrow. Focus on quality growth assets. Now, if you can't afford to buy a house in Toorak, buy a 2-bedroom apartment. Can't afford a 2-bedder, buy a 1-bedder. Better that than buying a 5-bedroom house in Dandenong, okay? In terms of capital growth potential and defaults as well. So you can see definitely median price fluctuations. Absolutely, the property cycle is cyclical in nature. It goes up and down. There's an emotional high and a reactive low. It's been happening like that since day one. There's nothing new to see here. These are not the drawers you're looking for. Brisbane, negative 2% for November, 5.6 negative for the quarter, 3.3 for the last 12 months. You can see there, it was doing nothing for quite a while, just go flatlining, then you had a boom, decline, and now it's still going to go further down, in my opinion. Adelaide, who cares? Perth, well, Perth is the same pretty much as Brisbane. Actually, Adelaide is doing the same thing. I'll come back to Adelaide. I'm getting some emails from people who are living in Adelaide. Why do you always skip over Adelaide? Well, it's like a regional town, really. I don't have any issues with Adelaide. I think Adelaide's very pretty, and I have family there. I think Glenelg is awesome. North Adelaide's awesome. The wine region is probably the best in Australia. Okay, so I'm purely talking about capital growth potential and population. So I'm not bagging Adelaide. Okay, don't send me emails. I'm just saying that there's a matching principle between supply and demand in Adelaide that will never create enough pressure on property market to go up to such a level like it has in Sydney and Melbourne. So if you're going to invest money, live in Adelaide, but don't invest in Adelaide, invest where you're going to get more money. It's the opportunity cost of buying Melbourne versus Sydney versus Adelaide. I always would choose Melbourne, Sydney, or even Brisbane. So great area to live in, probably not the best area to park your money in terms of growth potential. And this is a mathematical fact, okay? This is not an opinion. It's just proof in the pudding. Perth is the same. We had a boom, we're going down. Same in Hobart. So you can see that we are definitely going into a decline in the property cycle. Without question, guys. There's no question about it. Darwin, Canberra, same thing. Sales and listings is what I do look for, which is very important. This is probably the most important data that I look at, because I'm going to show you what to look for and what to kind of be aware of, but probably not focus on too much. Sales volume are tending lower as buy demand slows. CoreLogic estimates that in 12 months to November, there were 535,356 sales nationally, down 13.3 compared to the previous year. Sales estimates are still 10.8 above the decade average annual sales volume. So we are 13% lower. So a lot of people have taken properties off the market because they're not getting the price they want. And because they've taken the properties off the market, the median price have shifted to the left. That's what's happened. That's why it's lower. Okay. So in Australia, for example, you can see there, the sales volume, which is the amount of properties that are listed on the market, has declined by nationally 13.3, regionals 14, and major capital cities 12.8. So definitely, and you can see there was a peak. So when the market's hot and everyone's buying everything, this is before the RBA started to increase interest rates, people were getting the prices they wanted. And in fact, the regional towns boomed. You know, Queensland boomed, Sunshine Coast, Gold Coast. Melburnians left Melbourne because Dan Andrews shut down the whole state for 2 years effectively. And then they went up to Queensland, and some of them are coming back because it's not as exciting as Melbourne and Sydney. The nightlife is non-existent. I mean, everything shuts at 7:30. But it's a great place to live for lifestyle. It just depends on what you're into, you know, and what you do with your life. But definitely, like, the volume has gone down because people are not getting the prices they want for properties. Days on the market is very important because it's the amount of days it takes to sell a property. So when the market's ridiculously hot, it takes like 20 days to sell a house, which is ridiculously, like, it's 2 weeks virtually, and then you got to do contracts and it's sold. Normally it should be for Melbourne, and what is normally, because we're talking about the whole city and we're talking about, you know, national markets, but really 30, 40 days is a good market to sell a house. A month and a half, you do a few opens, you have an auction, 6 weeks. You know, when something's selling in 20 days, 19 days, that is ridiculously fast. You know, like literally you're listing, you're getting people in, they're getting contracts. It's ridiculous. It's unsustainable. So in November 21, which is the dark purple sections, you can see in Australia, houses were selling in 20 days on average, which is really, really fast. And really that data was really dominated by regional towns, sea change and tree change. Now, in November 22, they're selling in 35 days. So the volume has dropped, and the time it takes to sell a property has increased in days, which means there's less demand for properties. Combined regionals went from 22 days, which is crazy for regional towns. Now, regional towns usually take 2 or 3 months to sell a house. Like in Bendigo, Ballarat, if you've got a really nice property and it's in a prime location, 2 or 3 months is a good time frame to turn that around. 22 days is insane. You're pretty much listing, doing a few opens and selling, you know. Now it's 42 days. So it's virtually doubled. And same with combined capital cities, 19 to 32. So yes, it's taking longer to sell properties, which is a reflection of negative consumer sentiment. And you can see there that the consumer sentiment, market on days, has gone down in 21, which was this is kind of the reverse of the property cycle. So that was like the peak of the market, and now it's going back up. So you can see it's cyclical. It's just up and down, very predictable. Vendor discounting is also very important because it tells you about how desperate vendors are to move out of properties and how much they're offering as a discount. Pardon me. So vendor discounting has also expanded from negative 2.9 3 months November last year in the 3 months to November 22. The median vendor discount for the national level was negative 4.3. The higher the volume of discounting means that the market's getting softer and softer, right? Because if there's no discounting, pretty much vendors are getting whatever they want for their properties. Because remember, vendors are always unrealistic about how much the properties are worth. They're always thinking they're worth more. So if they're discounting larger amounts to get the property sold, it means that the demand is dying down, it's slowing down, and therefore they need to give bigger discounts to sell the same property. So national level, 21 is the dark purple, 2.9%, it's virtually very low discounting, and now it's 4.3. There's more discounts now required to sell the same volume of properties. I remember volume has dropped as well. Combined regionals, 2.9 versus 4.3, and major capitals, 2.9 versus 4.3. And once again, you can see there, this was the peak of the market, and then we're going down, and that's a reverse section because it tells you that the vendor discounting now is increasing. So 4 weeks to the December, new listing remained low at 37,000. So you can see that this is to do with volume of listings. And look, this is very generalized because obviously within suburbs, you have very different volumes of listings. And there are bigger suburbs just by geographic size. Like for example, in Melbourne, Moorabbin is huge, right? Bentley is a huge suburb, right? Moorabbin is small. Bentley is a big suburb. Moorabbin was resigning to Bentley. So Bentley now has become a huge suburb. So the volume of houses in Bentley is 3 to 4 times just by sheer size compared to Moorabbin. So it's not only you have to consider different markets, but you got to consider the amount of properties that are located within those markets as well. But this has to do with also with the volume of listings per area, and generally speaking, how many listings are on the market. When consumers feel confidence that they can get a good price for their property and they can secure good finance at a fair rate, and they feel secure in their jobs, they upgrade properties. When consumers feel uncertainty, which is currently with the different energy prices escalating, interest rates going up, food going up, they defer upgrading their houses and they stay put, which is what's happening now. So definitely it's a reflection of consumer sentiment that is happening. And once again, total advertised stock levels, once again, are relatively low across Australia. So you can see there, combined major capital cities, we're literally like 30% lower, 26 for Australia, 19 for regionals, and 30 for major capital cities compared to same time last year. So in Victoria and in Melbourne, 35.9. So people are virtually not listing properties, and especially now in November, December. I mean, it's the end of the market's pretty much closed. This is the auction clearance rates. So out of 100, which is everything sells, this is how we're tracking. And remember, there's no market in December and January, so there's a gap there completely. But you can see that we're tracking at the moment around 63%, which is an average market. It's an average market. Hot market's 90% plus, unsustainably hot. An average market is 40%, that's a low market. And then an average to slow market is like 50, 60%, which means 6 out of 10 houses are selling before getting passed in. at auction. What this data doesn't capture is the sales that occur after the property has been passed in at auction, because the best time to buy a property is after it was passed in at the auction, because then you can make offers and then you determine how desperate the vendor is to sell. The good news is, within all the doom and gloom, is that rentals are going through the roof. And this is the thing. The people that were smart that bought properties 2 years ago in Melbourne, on average, would have seen a 15 to 20% increase in their rents. The increase would have absorbed any interest increases. The people that are buying properties now in Melbourne can't get that increase in rentals. They've missed the boat. So what happened to all the engineering people that are listening to this? This is the bottom of the market. If you buy today, you would have missed out on 20 to 30% growth on your property in rental yield increases. You should have bought 2 years ago when I was telling everyone to buy. But people just don't listen to me. I don't know why. Who cares? I don't really care. I never have. I'm just sharing this information with you guys. I'm not judging you, okay? Because obviously your level of awareness will determine your level of action. So if you haven't got the awareness, you won't act. Why would you? So in terms of rental increases, now remember, historically in Australia, rentals kind of tend to mimic inflation, really. Like if you look at the average suburb, rents go up by 3-4% per annum, if that, And a lot of times rents don't go up at all because rental contracts are fixed for 12 months at a time. So you're kind of plateauing, and then your property manager gives you a call and say, hey buddy, that townhouse that you're leasing for $650 a week, now it has to be $700, right? Well, I'm getting phone calls where I'm increasing rentals by $100, $150 a week, which is unbelievable, which is off the charts, So the increase in the interest rates that I've experienced on my personal property portfolio, which is virtually all variable, because I'm always a fan of variable rates, is nothing compared to the increases in rentals that I've experienced. It's cash flow positive, but that's why you got to get started as soon as you can and just got to consistently invest. So in Australia, rents have gone up by 10.2, which is unheard of historically. Massive increase, and that has absorbed virtually all the interest rate increases for those investors if they had them variable. Now, if you've listened to my YouTube channel, I was telling people to fix rates 3 years ago, right? And I picked the bottom of the rates market because I knew that eventually inflation was going to be a factor because America kept printing money and the damn government and everyone else was printing money and throwing it at the public and everyone was sitting at home. So you don't have to be a genius to work out that, hey, I think inflation is going to go up in the future. If you keep printing money and no one's working, it's going to devalue the dollar, okay? This is like economics 101 year 7. So if you went to my live events in March 2019, 18, I was telling people fix rates now for 10 years, fix rates now for 15 years. Now, you've missed the boat on fixing rates. You're better off variable. This is also through October, rental yields. So rose 3.71%, which is crazy, when you think about it, just for the month, up from 3.21 in January this year. It's crazy what's happening to rentals. And there's massive rental stress in Melbourne. I mean, there are some areas where properties are getting a 6-7% rental yield right now, which is unheard of because normally, if you look at like Cheltenham, Mentone, Balmoral, historically those areas should have a rental yield of 3%, 3.25. 3.75, you're laughing, and often enough when you're buying, it's 2.75 or 3. And I'm saying 6-7% rental yields. It's just unheard of. Now remember, you've got to buy the property and hold on to it to get the rental yield because the moment the capital growth goes up, rental yields go down. So you can't buy a property with a 7% rental yield, okay? When you buy it, it's going to be 3.3 or 3.5% because you can't get both at the same time when you're buying a property, okay? So let me just unpack that even further. Let's say you buy a townhouse in Cheltenham for $1 million 3 years ago, and today it's worth 1.2. So you're getting your rental yield of 7% on $1 million, not on 1.2. At 1.2, your rental yield will be 3.5%. So you can't buy a property at any time in Melbourne where the rental yield will be 7% in the blue chip area. It just doesn't exist because the rental yields drag up capital growth, okay? And it kind of equalizes at 3.5%, 4%. So those of you who are waiting for cash flow positive properties in blue chip areas, net cash flow without negative gearing, you're going to be waiting forever. It won't happen. But if you buy and hold it long term, eventually they become cash flow positive. And it takes around 6 to 7 years. If you just look at the normal property cycles, if you were lucky to buy 3 years ago, before COVID or during the first year of COVID, you would have made 30% on your money on average. I'll show you which suburbs in a second. And the rental yield would have been 6%, 7%. It's crazy. Now, this is dwelling approvals. Dwelling approvals are record low, so 11% drop. People are not buying brand new development sites. They're deferring because they're uncertain about interest rates. Developers are not putting in DAs because of fixed contracts. There's a developer going under virtually every day in the media, and some of the biggest developers in Australia have gone under or on the brink of insolvency. So there's a lot of negative sentiment out there in the building industry. Shortage of labour, so labour costs have gone up. Shortage of materials because of the disruptions associated with COVID-19. So getting shipping containers in from China is becoming a nightmare. So things like timber has gone up by 60%, steel have gone up by 60, 70%, even like tiles have gone up by 14%, white goods 6%, unheard of in 12 months. It's completely left field. So because of that, we've had a drop in building approvals, which means in the future there's going to be, in the pipeline, less approvals going through, less builds coming through, more pressure on property prices. Guys, when the migration people, the 200,000 people or 250, come back into Australia next year, we're going to have the beginning of the next property boom because of supply and demand. Remember, there's only around 50, 60,000 rentals in the country right now. We're going to have 250,000 people coming in. Do the maths. It's very basic mathematics, okay? There's not going to be enough to cover them. So rentals will keep going up in value at a macro level. Now, obviously, micro level, there's different rental pressures in different suburbs, but I'm saying macro level, 50, 60,000 rentals nationally, 250,000 people coming in. Where are they going to live? They can't live in tents. And remember, these are people with cash. They just can't get a loan for the first 6 months. They've got to pass the probationary period in their job. So they're going to be all renting. All the new migrants always rent. So really interesting times ahead of us next year. Housing finance, very interesting, goes up and down. I won't talk about finance because I'll do another video. It's very complex in terms of what happened and why it's happening and when it's happening. Yeah, I won't even talk about it because once I start talking about it, this is going to be a two-hour video. Investors and lending. Investors went in hard during COVID-19. The smartest money went in during the worst time because they knew how to discern and they understand value. If you don't understand how to assess value, everything is worthless. So you stick to the fundamentals. Warren Buffett 101, Ricky Kiyosaki 101. You buy at the bottom of the market. The bottom is already passed, by the way. So it is what it is. I'll skip that. RBA lifted rates to 3.1%, which is unheard of, historically speaking. The Board have increased rates by 25 basis points. In December, Australia remains, inflation is 6.9% in CPI to October. That's going to be going down to around 3.5, 3.75. It's still tracking too high. So that means there's potentially another few increases on the books early next year, which will create more pressure on the market before we see any kind of change in the market. Through October, fixed rates remained elevated on variable rates for owner-occupiers and investors. So one thing that's happened is variable rates for owner-occupiers is the red line, 4.58. Fixed rates are 4.88, and then fixed rates rated 3 years, 5.31. So the trajectory is still that rates will be going up further in terms of where they are. We still haven't got any signs at all that I'm convinced of that rates will come down. Inflation has to be solved before interest rates will come down significantly. So, and this is why owning properties gives you that security because you've got equity in your property. So imagine you're a homeowner, you've only got one house. and suddenly you're paying $1,000 more per month in your mortgage repayments, and it's killing you, right? It's not forever. It's just for the next year or so. Well, imagine that's 12 grand a year extra in money. Imagine you have an investment property with $200,000 line of credit, which is not a lot of money. How many years does it buy you? 10? Do you really care then? You can cover your losses by drawing equity out of your property. So you're just going to get through the tough periods to come out the other side and never lose money. The most important thing about investing is don't lose money. Rule number one of investing, Warren Buffett, do not lose money. Rule number two, see rule number one. And he doesn't say it for a joke, because if you go under, it's going to take you a decade just to get back to square one. So you can't afford to, even during the lowest points in the market, to lose money. What you want to do, ideally, what I do, and a lot of my friends, is buy at the bottom, when the same properties are discounted for different reasons. And that's what you want to do. You've got to get to a level where you're buying at the bottom, revaluating at the top. Counter-cyclical investing. We want to talk about mortgage aggregators. This is the big picture, guys. The big picture is this. You got to stop focusing on all this stuff, the white noise in the media. The war here, your war in Ukraine. There's always going to be wars. There's always going to be companies going insolvent. There's going to be crises, international economic crises. We're going to be on the brink of war every year. We've been on the brink of war since I was 6 and 7 years old, since we got out of communist Poland in '85. We've always been on the brink of war. You know, nothing's new, guys. It's the same story playing out over and over and over. You've just got to focus. Whatever you focus on expands. If you focus on the world shit, everything is going to implode, then you're going to do nothing, right? You're going to be paralyzed. If you focus on seeing opportunities around you and getting the right team around you of other like-minded individuals, then guess what? Your results will be positive. Whatever you focus on becomes your reality. That's the thing. I focus on the big picture. This is the big picture. In 30 years, houses have gone up in Australia by 453%. Currently, they're tracking at 928,000, right? They were tracking at 180,000 back here in the 90s. Yes, we're going to have bumps in the road, absolutely, for different reasons. Recessions, depressions, interest rates going up. So what? What does it all mean? Does it really mean anything? As long as you can finance yourself through the bottoms and then take advantage of the growth potential which we're going to experience, because the country is such a young country with all these migrants coming in, you're going to become wealthy. If you allow the media, which is broke and uneducated, and broke academics dictate to you what you're going to do, guess what your results will be? You're going to end up dead broke at 65 with one house paid off, 150 grand in your super, because you've listened to all these idiots for 30 years. Financial planners, academics, the news. Keep reading Herald Sun, you're going to be in trouble financially. You got to start discerning about what you put into your psychology, because that will determine your outcome. Even for apartments, the growth has been staggering. 636,000. Huge. This is for major capital cities. You know, if you look at the growth, for example, in Melbourne, between 92 and 2002, okay, which is 10 years, which is the red line, we've gone up by 95%, nearly 100%. You would have doubled your money. 2002, 2012, Melbourne, 69%. 2012, 2022, 69%. And that's the average for Melbourne. I've got properties that have doubled in that time. Some of them nearly tripled of doing nothing. There's many properties that I've seen my clients have sourced where they're making 50, 100 grand in just capital growth per year, which is nearly what they earn in their job. Don't worry about the short-term fluctuations, guys. It's just part and parcel of the risk of being in the market. So the reality is you've got to focus on the long-term view, not the short-term 3 months, 6 months, 12 months fluctuations. You've got to focus on the bigger picture. The bigger picture is where the money is. We're going to have recessions, we're going to have all these things happening, but look, it's an upward trending market. That's what you got to understand. Now, yes, it's cyclical in nature, absolutely. There's a peak, there's a decline, bottom, and there's the growth of the market. And there's all these different triggers that happen. rental yields falling, oversupply, rising interest rates, lower property sales, construction decreasing, which is now, property prices falling, increasing rental yields, which is going to happen next year as migration comes in, undersupply of rental properties, because remember, developers are shelving future projects. The pipeline is already 10% lower, 13% lower in Melbourne. Undersupply of rental properties, falling interest rates, which will happen eventually. We'll get back to 3%. Rising property sales, construction costs comes in, increasing, bang, we're at the boom again. And whatever you buy here doubles over here. That's the reality. That's how I look at the whole market. You just want to buy and hold, focus on quality, not quantity, quality of the asset, long-term view. Buy something that you never plan on selling. Buy something that you'll give to your kids. Yes, there's an emotional peak and a reactive low, but the average has always been around 7 to 10%, depending on which major capital city you're talking about. Now remember, when the market's negative, which is now, and this is standard deviation curve, if you remember year 9 mathematics, when the market is down and the volume diminishes, which is now the volume is 30% lower in Australia than it was 12 months ago, then what happens is the median price shifts. It doesn't mean that every property is devalued. It just means the middle property this year is lower than the same time last year by 10% on average. Yeah, absolutely. So where are we in the property cycle in Melbourne? We're right here. We're going down into stabilisation and the bottom of the market. Now this could be very quick. This could be 3 months, 6 months, 12 months, you know. I think the bottom, in terms of where we are at the bottom, in terms of the lowest part, is already right now. It could be between November, December, and it could be even January. We won't know until next year all the data comes out. Now ideally, if you want to pick the market, you want to buy from here 9 o'clock to 12 o'clock, okay, if you want to time the market. But what if you get there and you can't borrow the same amount of money? You've changed your job. Your serviceability is lower. The stock that you're seeing isn't the stock that you could see here. So my advice is forget about the property cycle and just keep buying whenever you can. Because even buying a property, from the amount of research you do, the paperwork, it's 6 months on average. It takes 2 or 3 months to find the property, due diligence, then you do a 60 or 90-day settlement, contracts, checked by a lawyer. There's your, 6 months gone. So this time in the market thing is just, it's for dreamers. I've never met anyone successful that times the market, ever. Even if you get it right once, how sustainable is it? How many times can you replicate it? It's impossible. The people that I meet that are successful are the ones that consistently invest throughout all parts of the cycle. They just focus on quality. Sometimes they overpay, sometimes they underpay. It averages out. That's what it is. Now, if you want to check where we are in the property cycle, jump onto Herring Todd White Valuers. This is the November month in review. You can see Melbourne's just here in the decline. This is where we are. And there's some parts of Australia that are already at the peak. Remember, the stealth money is already coming in now. The public always gets there late and they overpay at the peak of the market. So when people are negative, get in at the bottom. Do the opposite, counter-cyclical investing, guys. When you see everyone making a killing in property, that's the worst time to buy. When you get to every barbecue and everyone's telling them how much the house across the road sold for 200,000 more, that's when you increase your equity levels and fix your facilities, increase your lines of credit and redraw facilities. That's not when you buy. You buy at the bottom of the market. Now remember, property clocks are different for every major capital cities, and then they're divided into 3 sections: in the suburbs, metropolitan and regional. So they're also very different from each other. Like in Melbourne, in Victoria I should say, you've got, for example, metropolitan and regional tracking together, but you've got inner suburbs at 3 o'clock. And these ones are about to go into a peak market. So Bendigo, Ballarat, Shepparton, they're all about to peak, in the next few months. Dollar cost averaging, guys. Keep buying whenever you can. Remember, when's the best time to go to the gym? Picking the market is like saying, I'm only going to train when the weather is 23 degrees, lightly sunny with a bit of clouds, and I feel fantastic. We're going to be training 3 times a year. The people that really get the results in the gym, whether it's bodybuilding, powerlifting, is the ones that go to the gym 5-6 days a week, whether it's pissing down raining, whether it's 40 degrees, it doesn't make a difference. They just keep going and they get massive results at the end. That's the same thing with property investing. It's just hard work, perseverance, there's no miracles, and it's not about timing. Now, in the Melbourne apartments are now booming. They've gone through the bottom of the market and now they're going up in value. So if you want to buy apartments, this is the time to buy. I've done a number of videos on apartments. You've got to be really careful what you're buying and where. Like apartments are a minefield, okay? You can lose money so quickly. It is ridiculous. But definitely South Bank has gone up by 19%, East Melbourne 20%, North Melbourne 14%, Parkville 11.4%. So definitely, in terms of opportunities, it's happening right now. They've already moved. So a lot of two-bedders, I'll be focusing only on 2-bedroom, 2-bathroom, double 2-car spaces, or one. But never buy 1-bedroom one. The worst thing you can buy in Melbourne is 1-bedroom studio apartment. I don't care where it is. You just don't buy them. It's like selling ice to Eskimos at the end. Suburbs that are struggling to pay mortgages and the cost of living, these are the areas you got to avoid, okay? And there are postcodes all around. You can get this data from S&P Global Ratings. There's a number of agencies that gather this data in Australia as well. The banks use this data. And you want to avoid these properties next 12 to 24 months because this is where a lot of people will be losing businesses and they're predominantly blue-collar areas. Which means there's going to be record insolvencies, record properties being sold at a really low level, which means if you buy something, you might not be able to get any capital growth for 12 to 24 months, which you don't want to do. There's currently 551,000 Australians that are struggling to pay their mortgage, which is 1 in 5, which is crazy, 20%. Now, these are the postcodes that have the highest loans in arrears. In Victoria, it's Broadmeadows, postcode 3047. 3.51% of people are in arrears in that suburb. So Victoria, currently you have, and it's tracking about 1% on increasing per month. So it is increasing definitely every month. There's thousands of homes in Broadmeadows that are in arrears with their mortgages. People have lost jobs, they can't get employment, interest rates have gone up, the story. These are the areas that have mortgages deferred by the banks, the highest level. Wyndham, you can see Casey, Wanneroo, Whittlesea, which is Walloon. That's pretty much, so for Victoria, it's the yellow suburbs, Broadmeadows, Bacchus Marsh, Boroondara. So these are predominantly new house and land estates that are suffering because of the mortgage stress levels they're experiencing. This is where they are currently located. So the mortgage stress in Melbourne are the dark patches. You can see there. They're in arrears. And the dark patches represent 60 to 80 houses per suburb, not per area. So they're clustered together in suburbs. Usually it's new house and land estates. And this is in the west. Now, can you get a bargain in those areas? Yeah, if you want to live there long term, probably an argument is, maybe get a bargain. Remember, living is very different because living is an emotional decision. When you're buying something and investing, you want to get the equity out as soon as possible and leapfrog from one property to another. So for investment purposes, not having equity available in a property for 2 or 3 years is crazy because you're missing out on securing another 2 or 3 properties over the period of time. High-end property suburbs have, and you're going to see a lot of articles, Toorak down 20%, Brighton down 30%, Hawthorn down 20%. It doesn't mean that they've actually devalued their houses by 20%, is that they've taken those properties off the market and the median price has gone to the left because the volume on the market has decreased by 30 or 40%. So you're going to see a lot of this kind of Toorak nearly 16.9, Lower Plenty, Armadale, 8.9, Box Hill, Caulfield, Brighton, you can see 4.5, 3.8 for St Kilda East, Hawthorn 3.7, Clayton 3.6, and North Melbourne. Now, this is actually, it's true mathematically, this is for the June quarter 22. Yes, it's factual. The median price in Toorak from the June quarter 22 to the June quarter 21 is 16.9% lower in price. So the middle property is lower by 16.9%. It doesn't mean every property in Toorak devalued by 16.9%. But that's what the media wants you to believe, you know, that people in Toorak have lost 16.9%. They haven't. You only lose money on property when you sell it. If you don't sell it, it's a paper loss. So no one's lost any money in these suburbs. And these are the areas you want to go in hard if you can get a discount. Most of the time you can't get a discount. Rentals are going through the roof in Melbourne. 7%, this is from the June quarter, and that's now 10%. And I think next year is going to be as high as 12, 15. There's already suburbs in Melbourne like the Bayside, within the Bayside area, Aspendale, Edithvale, Chelsea, where rentals have gone up by 18%, 17%. Suburbs like Blackrock, for example, Hampton, rentals have gone up by 12, 13% the last 12 months. Huge increase. So those investors with those properties are laughing all the way to the bank because the increases in interest rates have been absorbed by the increases in the rentals. They don't care. Unless you buy now, you won't get those increases. Now it's the bottom of the market, you'll be paying a premium for the same property with a rental yield of 3.75%. And this is the same for units. Rents, because units are cheaper, apartments, 10% increase in rents, especially the 2-bedroom apartments, 75 square metres, 2 bathrooms, 1 and 2 car garages. So talk about how you look at things, guys. It's about the glass being half full or half empty. I just drink the water, I don't question the market. The market is what it is. Let the trend be my friend, as I say. So I just do different things in different parts of the market. Now remember, these are the areas that are booming right now in Melbourne. Despite Melbourne market going negative, okay, this is in June quarter 22, Riddles Creek has gone up by 37%, Bond Beach 35%, Warrenwood 29.7%, Frankston South 28.6%, Patterson Lakes 28%, Edithvale 27%, Narre Warren North 27.2%, Blackrock 26.3%, Parkdale 23.7%, Aspendale 22.9%. So remember, even though the market is down 10, 11%, there are suburbs that are booming in Melbourne at the same time. And that's what you've got to be aware of, and that's what the media is not reporting. They don't want to report good news. They want to report doom and gloom, because otherwise you won't buy the paper, you won't watch the story. So remember, 5% of the market is they respond. 95 reacts. They get blown around like a paper bag. Depending on which camp you want to be part of, it depends on your level of education. That's all it is. And your level of exposure. The more level of exposure you have, the more education you have, the more discerning you are with your decisions. The less education you have, you're acting on fear. And on fear, when you just don't act, you do nothing. Now remember, what are the best properties right now to focus on in Melbourne? Where am I sourcing? Well, the same areas I've been sourcing back in 2019 and 20. Blackrock, Mentone, 30% growth. Frankston South, Mordialloc, Albert Park, Carrum, Parkdale, Balmoral, Frankston, Seaford, St Kilda, Sandringham, Aspendale. Now this is from December quarter 21. This is some of the projects. Now, I think Carnegie is going to be awesome. It's coming up a lot. There's many townhouses being built in Carnegie, which is a good thing. Carnegie, you need 1.2 million to get to 1.4 for a good townhouse. This is development that I've just sourced in Carnegie, in Tranmere Avenue. 1.2 million, 3-bedroom, 3-bathroom, due to complete early next year. Very good development. It's becoming a really trendy yuppie area. A lot of cafes, restaurants, wine bars, gyms, 24 hours opening up everywhere. Carnegie's always been really well located. You've got Bentley around the corner, Caulfield. I mean, it's all there, you know. I'm not going to go through the suburb with you. You can look it up yourself. You're surrounded by Carnegie's around, there's Murrumbina, Glen Huntly, Caulfield East, Malvern East. You've got some of the best shopping in Melbourne, some of the best cafes in Melbourne. No crime, very safe, family-orientated area. These are all the things that are located next to it. Great schools, primary and secondary, a lot of good Anglican schools and private schools. Great townhouse. Remember, when you're buying properties, You want to be non-family conducive. You want to buy properties that are targeting young urban professional couples with no kids or single parent with one child. You don't want to have 5 kids, 2 cats and a dog in your property because it'll destroy your property, okay? So you want to be targeting young professional couples. Triple story properties are especially non-family friendly, okay? So I just want to put this on record, guys. You can't discriminate, first of all, okay? So you can't kick families out of your properties, but you can choose a product they don't like, which is what you want to do as an investor. You want to have your assets protected. You want to have people that eat out every night, they're never there, and they make a lot of money, and they pay a lot of rent, which is Carnegie, okay? Double lock-up garage, master bedroom or Zoom room downstairs with a toilet, open plan living, balcony, kitchen island, bench top. You have a bathroom in here with a shower and a laundry. So you have open plan living, and upstairs you've got 2 bedrooms with 2 en suites, okay? 177 square meters, perfect 3 bedroom property for a young urban professional couple, okay? And that's what you want, you know, cash flow neutral or positive from day one. You just set and forget. No garden, no maintenance. Now, remember, you fall in love with the numbers, don't fall in love with the property. You might want to have a big garden with hundreds of square meters and swimming pool and everything else. That's not a good investment option. We're purely doing this to make money. If you're interested, by the way, just send me an email and I can send you the plans and talk to you about the property. There's 2 left in that project, 1.2 million, due to settle next year. I've already sourced another project in Carnegie, which will be coming out in March next year. Same project, $1.4 million. So 200 more just because construction costs have gone up. So imagine that. Already new projects on the market will be $200,000 more than this project. There's already $200,000 built in just because this project was started at the beginning of the year and the materials were a different price. Remember, construction costs in Melbourne have gone up by $96,000 for an average of 160 square metre build. $96,000. So forget about inflation going at nearly 6-7%, which is also adding pressure to property prices and scarcity of stock. Just building properties have gone up by 100 grand, just to build. Now, put in labour shortage and all the other stuff, you're going to be making 100 grand every year for the next 2 or 3 years, just without any population pressure. This is Mornington. Chelsea. Another project this is a 2-year off the plan project. The strategy here is you put 10% down, settle in 2 years at a much higher price point. 1,065,000. Chelsea is a great suburb. This is on the beach side of Chelsea, which is right there. So on the beach side. Great developer. He's done over 160 developments, 28 years. Know him really well. Good friend of mine. We have done 17 projects with this developer. Flawless. Probably one of the best developers that we deal with. This development, you've got no backyard, but you've got a rooftop terrace overlooking the ocean, which is very unique in Melbourne. Remember, Melbourne's very flat. We don't have the hills that Sydney people have. So we've only got the beachfront properties or properties where you can turn your rooftop into a deck. So you're going to have glimpses, not views over the beach, okay? Glimpses. You're going to have a blue line in the distance, about 30 metres away from the beach. Great property, great developer. Once again, these are 2-bedroom townhouses. So in terms of your design, you have single car garage, master bedroom with an ensuite, storage under the stairs, driveway, small little courtyard. Really, it's not even a functional courtyard. It's just an area where you can kind of go out and have a cigarette and go back in. But it is private. Then you have a balcony, another bedroom with an ensuite, open plan living dining area, island bench top. And then you have a whole rooftop deck, 5.9 by 5.5 metres, which is huge. So you've got a barbecue up there, you can put a spa, sauna. I mean, you can do whatever you want. And overlooking the ocean in Melbourne. 1,065,000. By the time it settles, you probably make 100, 150 grand in 2 years' time. So this is a longer term settlement. You can put 10% today, nothing to pay for 2 years. They're all the same, they're just a mirror image of each other. If you're interested, there's 3 left. the 1,065,000 bargain for Chelsea on the beach side of the highway. So you can walk down to the beach. Absolute bargain. Mornington, I've always been a fan of Mornington. I keep telling people to buy there. It's a great little part of Victoria. It's a coastal town, a bit of a drive from Melbourne, about an hour away. Increase of 48% growth in 12 months. Can you imagine? It just boomed for tree change, you know, and sea change. In terms of this area, 12 months growth, 18%. 3-year growth, 47.8%. 5 years, 44.7% growth. Just growth off the charts. 10-year average, 8.44. So when you're doing cash analysis, look at the 10-year average, definitely. This is the project there. This is the main street where all the shops are. So it's walking distance to Coles, all the shopping, and this goes right to the end of the beach. Great little townhouse, once again targeting young professional couple with no kids, your target audience. Architecturally designed. There's the main drag there. You can see the main road. That's where all the shops are, and that's where the development is just there. This is the beautiful boats and the beach that you have in Mornington. A great area to live in. Just like you feel you're on a holiday, but you're just an hour away from Melbourne City. You know, just magic. Once again, single car garage, master bedroom, toilet downstairs, storage under the stairs, and then you have open plan living. Another bedroom with an ensuite and a balcony. So this one's here, in terms of availability, you're looking at 695,000. There's a few left still, and for the 710,000 for the one at the Rio, which has a slightly larger courtyard. So once again, Mornington, great suburb. Been sourcing there since I started the company 10 years ago. I'll continue to source in Mornington. Big fan. It's a coastal town. It always does really well. Very good population growth, great schools, great access to the city, great beaches. It's a no-brainer. And you're getting something really cheap, which you can't even buy in Melbourne. I mean, $695, that's construction cost now for Melbourne. Then you've got to pay for the land and the margin for the developer. So in Mornington, by the way, with an average income, it's cash flow positive by $11 per week with negative gearing. This is another development in Port Melbourne for those of you who will be upmarket, 1.425 million, completed 100%, they've been lived in, which is number 3, which is this one here. Port Melbourne, top 10 suburb of Melbourne. I'm always sourcing in Port Melbourne, Albert Park, Middle Park. If you build up your whole portfolio just with Albert Park, Middle Park and Port Melbourne, you can't go wrong. No research, just buy whatever you can. Except for apartments, just townhouses and houses in those areas, you can't go wrong, right? There's your solution. You don't need to read any more books, go to any seminars, just go to Port Melbourne, Albert Park, Middle Park, buy a house or a townhouse, and that's it. There's your whole strategy. You just can't go wrong. They're always going to be in the top 10 suburbs in Melbourne. You can't develop anything in those suburbs. There's heritage protection, single dwelling covenants, height restriction, density restriction. Everyone wants to live there. It's the best suburbs in Melbourne. 2 k's from the beach, on the water, great cafes, exclusive. It's all rich people. It's amazing. It's one of those things where if you've ever experienced life, I used to live in St Kilda. I know the area really well. I used to go, back in the day, 20 years ago, when I was really fit, we used to go running every morning down Beach Road. Used to get up at 5:30 and run for an hour with my wife. So I've experienced those areas, and they are some of the best areas in Melbourne to live in. Great property, 3-bedroom townhouses, 100% completed, never been lived in, ready to settle. 30-day, 60-day settlement, whatever you like. That's the actual property itself. Study nook. That's the beach in Port Melbourne. Great beach. It's just amazing suburb. So once again, 183 square metres. You come in, you've got a bit of a courtyard. Open plan living, study nook, powder room. Then you have open plan living, kitchen, island, bench top. And then you come up into level 2. You have 2 bedrooms with an ensuite, built-in robes. And then you got the master on the level 3, balcony, ensuite, a massive, massive oversized bedroom. Once again, targeting the young professional couple with no kids. The growth, well, 12 months, 6.5%. Why? Because The volume has shrunk. People have taken properties off the market, especially for houses. 38% growth for 3 years, 28% for 5. 10-year average, 8.14. The average over 10 years will be obviously on brand new properties is very different than older established properties. People want brand new houses and townhouses in Port Melbourne. There's a lot of Victorian properties that are falling apart that just land value. So people want brand new there. On brand new stock, you're looking at 10% growth, 9% growth. 3-bedroom townhouse, 1.425 million. For that one, 9% cash flow positive, $9 cash flow positive per week. By the way, if you enjoyed the video, I encourage you guys to do further education and also come and see me and set up a meeting if you want me to source properties for you. I've noticed there's 4 types of people out there. Okay, there's the analytical compulsive information gatherer. They usually don't do anything. They just keep analysing the market and waiting for the best time to get in, which is never going to happen. There's the get-rich-quick gambler, which I'm really concerned about. I see them all the time. And they want to get rich and retire within 2 years. I can't help them either. There's the comfort investor. They only want to buy around where they live, within 6 or 10 Ks. Okay, so they're difficult to deal with. And there's the savvy, educated investor that look for growth assets irrespective of where they live in. They live somewhere else, they just invest to make money, which is the person that I want to deal with. Now, to get to that level, you've got to get a lot of education. That's the key. So if you're interested in learning more, I'm running live events again next year called the Real Estate Investing Fast Track Weekend. You can get onto my website, realestatefasttrack.com.au. There's only 40 seats available per event, and that's it. We run them here in St Kilda in my office. I'm right here in the boardroom right now doing this video. So if you want to spend 2 days with myself, Stephen Molnar, Cameron Fisher, and Stephen McClutchy from Loans Australia, and learn all about how you can set up your property portfolio correctly, how you can smash your mortgage in record time, and replace your income, this is definitely the event to attend. And in terms of running, it's usually on a Saturday and a Sunday. And in terms of cost, it's $47 for the 2 days, plus you get a hard copy of my book, which is Australian Real Estate Investing Made Simple. The best $50 you're going to spend in your life on education. I guarantee you, and I've got a money back guarantee, which no one has ever asked for, if you're unhappy for any reason, or if you don't like my suit, on the second day, I'll give you all your money back. I'll give you the $47 back, and thank you, and we'll part as friends. No hard feelings. Also, we had a big event halfway through 2022 called the Property Portfolio Accelerator Summit. And it was very successful. It was 4 days of extreme detailed education. We had multiple speakers there. We had lawyers and we had quantity surveyors, accountants. We unpacked all the topics that everyone asked questions about: how to buy property through trusts, business banking, replacing your income, valuations. And what we've done is we've recorded that at-home study, turned it into an online video course. So we recorded the 4 days, we've chopped it up, edited it, and now we've recorded the whole thing and made it available for you guys, which is coming soon. So get yourself registered on our database if you haven't already, because I'll be sending information on how you can get this. And this is an amazing 30 hours of contents, very detailed, kind of a blueprint on how to replace your income in record time, and how to pay off your mortgage, and how to build up a large property portfolio that will generate financial independence for you and your family. So this is going to be released around Christmas 2022. So stay tuned for some emails. There's going to be some specials offered as well. Very exciting. This is something that took a lot of effort to put together, and these speakers were amazing. Also, if you want to have a 60-minute free consultation with myself, then definitely that's something you can do. I just want to cover this very quickly before we finish off the video. And what I do is I sit down with you, work out where you are, where you want to be, give you some feedback. The most important thing is, guys, you've got to have a plan. If you fail to plan, you plan to fail. Most people spend this in their life. From going from A to B, they waste so much time and energy, buy the wrong properties in the wrong areas. They buy Docklands and Gold Coast properties and ostrich eggs and all these other contraptions and devices. And if they just started to buy properties 20 years ago, they would have been millionaires today. So what I'll show you how to get from A to B with the least amount of effort, maximum possible effectiveness. You get an hour for free. There's no strings attached. We work out where you are, where you want to be, and then I'll give you some feedback about how to get from A to B in the least possible time frame. Also, I'll give you access to my mortgage broker, my financial planner, my accountant, my lawyer, everyone, my insurance specialist, so you can get your whole framework set up and get that team happening behind you. Honestly, just getting the team is worth getting this free consultation. There's a bit of a delay. Usually I'm booked out 2 or 3 weeks ahead of time, so there's a bit of a wait to get in. And I usually do these via Zoom. You walk away with a real strategy from this meeting, so you know exactly what to do and what to action. It's a step-by-step, paint by the numbers, so to speak, blueprint for success. I've done this hundreds of times with hundreds of people. I would say to thousands now over 10 years. We're very successful. A lot of our clients are buying their 6th, 7th, 8th, 9th property using our system. Now, you've got to qualify for this. There's nothing special you've got to do. You've just got to have enough income to actually justify having the consultation, because property prices are going up and I can't help everyone. So for an individual person, you've got to have about 95 grand per annum in income, and you've got to have about 126,000 in available cash or equity in a property. Then I can show you how to get into your first property, which would be around the 700,000 mark. If you're earning less than that, I can't help you. I'm not sourcing anything less than 695, and that's not even in Melbourne. And I'm not planning to have anything less than 695 in the future. So you might want to go to, get someone involved that's sourcing regional towns or other areas, or just buy it yourself, If you're a couple, you need to be on about 140 grand and have 126,000 available in equity. So you can borrow money or have 120,000 in cash. That's kind of for a 695, 700 purchase. That's all you need to do to qualify. Just have the ability to borrow money. If you can't borrow money, guys, then there's no point seeing me, because what I do involves borrowing money. You've got to buy a property. Unless you're paying cash, you've got to borrow money. So for those of you who've been to a live event, just fill out this form. Otherwise, if you're just listening to this on YouTube, all you've got to do is email me directly, conrad@investorsprime.com.au, and just say 60-minute free strategy request, and just give me your details, your first name, surname, email address, mobile number, and I'll organise a time to catch up. Guys, I hope you enjoyed this video, and I hope you have a great Christmas break and a Happy New Year, and I hope to meet you in person at one of my future live events. This is Konrad Bobilak. I'll see you on the inside.